Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. How are you this morning, Tyler?
Good morning, Dean. I'm doing great. How are you?
Good, thank you. Today we're going to talk about whether you should invest first or pay off your debt. This is something that Tyler and I hear an awful lot coming from people when we meet with them in our office. They will want to know, is it better to invest because I'm younger and I have longer to put the money away, or should I pay off my debt? And really the answer that we quickly come up with is both. Because there are certain situations where you do want to pay down your debt exclusively before you invest, and then there are situations where we'd like to see you invest more. So we're going to talk about some of those things, but really the bottom line is you would like to be able to allocate towards both. So we're going to talk about one situation that comes to light quite often, and that is, when somebody says that they want to pay off their debt, many times they go towards something that has a higher interest rate, thinking that that's the way to do it. Under certain terms it is, but we're going to talk about the snowball effect. Tyler's going to explain, we typically like to see the smaller debt paid off first so you create some momentum. And also there's a situation where, again, people will say, well, I'm not contributing to my 401k because I want to pay off my debt. But if you have a match, that might be hurting you. So Tyler, let's first talk about a match situation and what we normally do there when it comes to paying off debt or investing first.
Yeah, Dean, and like you said, this is a question that we were asked pretty frequently over the last, I guess all the time really, we're asked this question because it's applicable to almost everyone when it comes to investing versus paying off debt. In your lifetime, you have had or will have a form of debt, and hopefully you're able to invest as well. So investing versus paying off debt, first off, we'd like to see you do both. And there's one primary reason, or there's one primary scenario where it works really well. And I see this all the time, especially with younger people or anyone who's working. But if you have access to a workplace plan like a 401k or a profit sharing plan, something like that where the company matches, I'm a firm believer that you should at least contribute up to the match within your 401k and then pay off debt above that. Now, we're going to get to this in a little bit, but over time, we'd like to see you contribute 15% of your gross income into various retirement accounts. But when you're first starting and you have debt out there, if you do have a match, then we'd like to see you contribute up to at least up to the match. So, for example, 4%. We'd like to see you put in at least 4%, and then anything above that, instead of saving more for retirement, put that toward the debt until you knock out all the debt. But here's why: if you have a match, you should contribute to the match in addition to paying off your debt, because a match that can get you going when it comes to contributing for retirement. Because if you don't take advantage of that, then eventually your retirement time horizon, it's going to shrink, and that's less time that you have to put money away for retirement. So again, retirement is something that when it comes to saving for it, you have a limited time before you actually do retire. So if you keep on holding off, putting anything away for retirement, then your time horizon becomes that much shorter, and it's going to be that much tougher to save more down the line. So ideally, if you're working and you do have debt, but you also have access to a matching 401k, try and contribute at least up to the match. So invest that amount right away, but then also use everything else to pay off the debt in addition to that. Now, paying off debt first, it makes it easier to invest. So if you don't have that matching option within a 401k, you can still open up a Roth IRA and try and invest a little bit, but ideally, we'd like to see you pay off all the debt first. And one thing that we use is we're big Dave Ramsey proponents. We use the Dave Ramsey approach when it comes to paying off debt, and he calls it the debt snowball method. And what that is where you write down on a list all of your debts. You want to start with your smallest one to your largest one. So you're looking only at the balances. You're not looking at any interest rates. not looking at the type of debt. You're only looking at the balances. And again, you want to write out the smallest to the largest. So for example, just to make it easy, let's say you have a $2,000 credit card debt balance, $20,000 in student loan debt, and $30,000 on a new car. What you're going to do is you're going to list them out exactly in that order, regardless of what the interest rate is on that. So again, smallest to largest, and you pay off that smallest $2,000 credit card first, then the $20,000 student loan, and then the $30,000 car. Again, smallest to largest, and what that does is that builds momentum. And what we mean by that is typically for the everyday person, when you see those smaller debts being knocked out first, you're going to be more willing to keep going with the plan and keep on paying off the bigger ones and go right on down the line and knock all those debts out. Whereas the other way to do it is the interest rate method. And this, it technically makes more sense mathematically, where you pay off the higher interest rate first, because if you're letting that higher interest rate debt sit there, then it's going to accumulate more, and over the long term, you're going to be paying more on that if you don't pay that off first. But with that method, oftentimes I see it where people might have their largest debt. It might be a $30,000 that they've accumulated in credit card debt, and it might have the highest interest rate. They try and pay that down first, but after knocking down $30,000 down to $20,000, they pay off $10,000 of debt, but yet they still see $20,000 outstanding debt balance there. It kind of wears on them, and they're not able to build that momentum, and people actually fall off the plan completely, which is something that we don't want to have happen.
Okay, Tyler, one other point here too. First of all, as Tyler says, we follow Dave Ramsey very closely. He has a very common sense, basic approach to paying off debt and accumulating wealth. You accumulate wealth over the long haul, period. I mean, that's how you look at it. And you reduce debt wherever you possibly can first. You want to reduce debt so you can generate wealth without having to make payments on a car and credit cards and so on. However, there are situations where you do go into debt to generate wealth. And what we mean by that is if you're looking at, we'll see somebody come in and show us some of their debt, and it'll be a mortgage on a house, which appreciates in value. So you're creating wealth there. You're creating additional wealth. So at some time in your life, if you choose to downsize, hopefully you'll have a significant opportunity to make money on that house. Also, we'll see it with land or a potential business. With land, again, we see people with, they refer to it as debt. Yes, it's debt, but it appreciates versus depreciates. Always understand that appreciable assets are those things that are looking to grow, and when you put debt towards them, you're typically generating wealth, versus depreciable assets. For the person who has to have that $70,000 new truck, it's going to depreciate. You're going to lose 20% to 25% as soon as you go off the lot. So depreciable assets versus appreciable assets. That's how you want to look at it. Another thing that we see quite often is for those people who are trying to get their debt and start their retirement accounts, they're getting them going at the same time. They've got a good thing going. But then they question, okay, how much or when should I start investing for my children? And again, we go back to some of the approaches here with Dave Ramsey, and it's a very structured program. You take care of your debt, you start investing, and then you take care of your children. And part of the reason is if you're not sound financially, how can you possibly take care of the finances of your children, either through helping them with weddings or their first house, or more importantly, for schooling? So we always tell people, take care of yourself first financially. The children then will be taken care of much easier, because even if you don't put as much money into 529s or UPMA accounts for these children to go to school, chances are if you're typically investing relatively aggressively, at least 15%, you will have some accounts that you will be able to dip into to help them out should they need it.
Yeah, Dean, really good points here. Now, when it comes to, again, investing versus paying off debt first, ideally, if you do have access to a matching 401k, contribute at least up to the match and then pay off the debt. If you don't have access to it, you can go right to the debt. But one thing I forgot to say earlier is list out all the debt, not including the mortgage, because that's going to come a little bit later. But this is all your credit card loans, student loans, car loans, anything like that. not including the mortgage. So that's something pretty important that I wanted to make sure that was known. But not the mortgage here. Again, list out all the debt, smallest balance to largest balance, and do the debt snowball where you knock out one debt after another. But again, where I left off was the other method is the higher interest rate method, where you can list out the debts by the higher interest rate first and then pay them off that way. But again, I've seen it where people completely fell off the plan if one of the debts that have a higher interest rate also has a very high debt balance, and they seem like they're paying it forever and forever and forever, and they're not building that momentum, and they just completely fall off the plan and decide, you know what, this just isn't for me, and I'm going to have debt for forever, which obviously is not something that we want you to think. So again, we recommend both if you have access to a match. Otherwise, try and pay off that debt first, because paying off the debt first will then make it much easier to invest. But like you said, Dean, when it comes to Dave Ramsey's structured method, there's a way to go about doing it. And before you even start paying off the smaller debts, we'd like to see you save $1,000 in an emergency fund. And here's why. You put the $1,000 away because the last thing that you want is, when you're paying off debts, the last thing that you want is if something happens with your car, something with an appliance in the house, whatever it might be, when you're being proactive and knocking out all these smaller debts, you want to have at least a little bit set aside if something else pops up, because the last thing you need is to set you back even more with an unexpected expense when you're trying to get yourself out of debt. So first and foremost, set aside $1,000 in an emergency fund, then go through and pay off all the small debts, not including the mortgage, from smallest balance to largest balance. If you want to do the higher interest rate first, you can do that as well. But again, many people find that momentum when they do smaller to larger balances. And then once you do have your smaller debts knocked out first, your credit cards, student loans, car loans, once you have all those taken care of, people can do that within less than a year it might take closer to 5 to 10 years. But once you do have that taken care of, then comes the next step, which the next step after that would be taking that $1,000 emergency fund and building that into 3 to 6 months worth of living expenses. So first you want to do that, and reason why is you have all your debts paid off, but if something were to happen to you health-wise or job-wise, if you were to lose your job, you want to have at least a little cushion in there, so that way you're not going into debt again and putting things on the credit card in between jobs or for health bills or stuff like that. So again, once you do have your smaller debts paid off, then you want to save up 3 to 6 months of living expenses in savings. Some people feel more comfortable with only 3. Other people are going to feel more comfortable on the higher end with 5 or 6 or even more than that. But really, somewhere within that range is ideal. And again, it's what you feel comfortable with. But again, you want to bulk up your savings a little bit, so that way if something happens, you can tap into there and not go into debt. And then after that, now it comes time to really get down to investing for retirement or even outside of retirement. But typically, once you have your debts paid off, then you're going to want to go into investing. So now at this point, what we like to see is 15% of your gross income invested into various retirement accounts. And that seems like a lot, but I recently just had this conversation with a couple clients the other day. And usually once you get all your debts paid off and now comes time for the investing part, you're not going to be able to do that 15% overnight. That's something that you have to work up to. Some people can do it right away. Very few can do it right away. But most times that's something that you have to work up to within 1, 3, 5, 10 years even. You have to work your way up to that 15%. But the sooner you can get there without cutting yourself too thin, the better. So what I mean by that is you want to save 15% into various retirement accounts. And the first place to go is your employer plan up to the match. So again, I talked about it before, and this is if you're, even once you get done paying your debt, hopefully you're already doing this, but if your employer matches 3%, then do at least 3%. If they match 4, do 4, 5, and so on. So again, whatever they match, you at least want to go up to the match. Even if you think they have poor investment options or the investment options are high fee, even if that's the case, I recommend still doing up to the match because it's free money. Again, even if it's a 3% match, you can put in 3% of your salary. The company puts in equal to 3% of your salary out of their own pocket. So again, if you're not taking advantage of the match, then you're missing out on free money. So you at least want to do up to the match. And then once you do up to the match, then we recommend going outside of the 401k or whatever your employer plan is, a 403b, 457 profit sharing plan. Go outside of that and into Roth IRA accounts. If you're single, do one for yourself. If you're married, both spouses should be doing one. But go outside into the Roth IRA. And Roth IRA is an after-tax account. So that means it's money that comes from checking or savings. You pay the taxes up front, and then it grows tax-free for as long as you defer it until you take the money in retirement. Then you're not paying any taxes on it. And Roth IRA accounts are very valuable for everyone, especially for younger people. And here's why. There's really two things that factor in: time and compounding interest. And if you're young, if you're just out of college, then you have those two things on your side. You have a lot of time to save within a Roth account, and with time, you have compounding interest. If you average even 5% rate of return per year, well, that 5% is compounding every single year. So you're earning interest on your interest over 30 or 40 years if you're young. So again, Roth accounts are very valuable because they're tax-free when you take the money out. So when you're retired, who doesn't want that tax-free income bucket? So that's why go outside and contribute to Roth IRA accounts outside of the employer plan up to the match. The other thing too, there's many Roth, now many companies are offering Roth 401k options. And that is a huge deal because with a Roth IRA, right now the IRS restricts how much money you can put into it. And it's $6,000 that you can put into it if you're under 50 years old. Now, if you're 50 or older, they give you a $1,000 catch-up contribution where you can now put in $7,000. So depending on how old you are, you can only put in either $6,000 or $7,000 into a Roth IRA account, which is still good. But if your company offers a Roth 401k, so that's a Roth option within your 401k, you can put up to $19,000 in it if you're under 50 and up to $25,000 if you're 50 or older. So that is a huge, huge benefit where you can put, over triple the amount that you can put into a Roth IRA into a Roth 401k. But again, a Roth 401k option is only available if that's offered through your employer plan. But if it is, don't be afraid to get up to that 15% mark all in the Roth 401k if your employer does offer that option. Now, like I said, more and more are, but there still are plenty that don't offer that. And if they don't, then contribute up to the match, then go outside to the Roth IRA accounts, then go back into the employer plan after that. And then lastly, if you're still able to save more, even a non-qualified or a non-retirement account is one that you could use if you still want to save more. And that's one where there's no restrictions on when you can take the money out or how much money you can put in. So you can use it as a non-retirement account where you can take the money before retirement as well.
Okay, before we continue, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions located on Allied Street in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, we're going to continue here with whether we should invest first or pay off debt. Tyler was taking you through some scenarios here on paying down the debt and where you should be investing. We talked a little bit about also saving for the children's education. Really, that comes last here, and part of the reason is you want to make sure that you're taking care of yourself first financially, because that's going to allow you to spend significantly more towards an education for your children. If you don't take care of yourself financially, it's going to be very hard. You're not going to commit to putting money aside for the children. It just happens that way. So Tyler, now you talked about the 15%. Let's talk about places where we should be putting that 15%. So as Tyler said, our goal is to have people set aside 15% each and every year for their retirement and investment accounts. So Many people tend to think that it only has to be 15% in your 401k or your corporate sponsored retirement plan. And as Tyler explained, that's a good place, especially if you do have the option for the Roth. Good place to go, but many people don't. So at least get your match. So if your company matches 3%, take the match. And then if you want to go outside of your company into different investments, do so. But again, we want to target that 15%. So what we typically do is we make it very easy for somebody to understand where this money should be allocated, the 15% or the remainder of. We go with what's called a bucket approach. And what we have are 3 buckets of monies that you should be putting contributions into over your lifetime. One is the safety bucket, second one is the income bucket, third one is the growth bucket. And understand that very seldom will you see even amounts put into these buckets. Sometimes as you start investing and you're younger, that growth bucket typically is full compared to the income and the safety bucket, outside of some of, as Tyler said, some of the emergency funds you want to put away. And as you grow older, the income bucket starts to fill up and the safety bucket becomes full at that point. So we tell people, let's look at, safety, income, and growth in that fashion. And some of the investments that make up the safety bucket these are things that we refer to, many of them, as fixed income. When you retire, people refer to fixed income in the form of Social Security and pensions. And there are also annuity products that can show up as fixed income because they can be turned into a personal pension if you would like that. So the safety bucket, you like to have cash positions. Your Social Security will eventually be in there. Your pensions, if you have one. If you don't have one, you can use an annuity to create a personal pension, and also treasuries. Tyler, what about the next bucket? When we talk about, the bucket of income, why is that important? What do we usually typically put in there for a retirement plan when we look at the income bucket?
Yeah, Dean. So we want to have your safety taken care of first, but then income are a variety of different investments that can provide exactly that income in retirement. So it's everything from bonds to various dividend-paying stocks to different dividend-paying mutual funds that are invested in dividend-paying stocks. But it's different investments that can provide income, and that's something that you want to really build up in retirement, because during your working years, when you're contributing to your 401k or your Roth IRA accounts, you're focused on growing the money and accumulating as much as you can. But then once you get closer to retirement and when you're in retirement, then instead of growing the money, now it becomes time to take the money out and utilize it as income. So one thing that people do is they transition from more stocks to different, or more growth-oriented stocks to dividend-paying stocks and even some bonds. And what that does is dividend-paying stocks, they're typically not as aggressive as growth stocks, but what they do is they provide income in the form of a dividend that many people take when they're retired. So instead of reinvesting that dividend back into your account to have your account grow, they now instead take the dividend as cash or an income to help supplement, their safety buckets, such as a pension, Social Security, treasuries, annuity products. They use that income from their dividend-paying stocks or their dividend-paying mutual funds or bonds to supplement their fixed income in retirement. So again, income and safety buckets are going to be smaller usually when you're in your working years, but then they become the largest ones once you're retired. And then typically the smaller one when you're retired is going to be growth, whereas the growth bucket was larger when you're in your working years. And the growth bucket consists of your growth stock mutual funds, your individual stocks, some growth exchange traded funds. But again, growth bucket is going to be all things that are very stock heavy. And again, stocks provide more growth potential. However, they are riskier and they're more volatile than bonds, cash, CDs, fixed products like that. But again, they're going to fluctuate in value over the long term, but yet over the long term, typically that's where you're going to see the most growth potential. So when it comes to investing the 15% into retirement, make sure you have a plan. We do like the 3-bucket approach, the safety, income, and growth. And like you said, Dean, it's very rare that you're going to have equal allocations, because the allocations that you have in each bucket are going to depend on where you're at. And again, I said it before, but Usually when you're younger, when you start off, you're going to have much more in the growth bucket as opposed to safety and income. Then that's slowly going to transition to once you retire, you're going to have much more in the safety and income buckets and less in the growth bucket because you're needing the safety and income right now, and the growth is a smaller allocation because you don't necessarily need that when you're fully retired.
Okay, and a couple other things too. When you're looking at saving that 15% over your lifetime, you want to try to get it started early on. As Tyler says, you have compounding interest working for you and time working for you. The earlier, the better. Some people say, well, I can't afford to set aside 15%, so they don't set aside anything. That's absolutely the wrong thing to do. No matter how little it is, just by starting is going to be a good thing because you'll create a habit. Eventually, you'll contribute more. So get started, and it's never too late. Some people say, okay, I didn't start early. I'm in my 50s. Now it's too late. Well, it's not. Anything that you save is going to be used in your retirement. But a couple other things you can look at with that 15% that you are trying to allocate towards investments. Again, real estate can be considered in there too. Real estate is a wonderful investment provided you do your homework, and many times that real estate can generate income in your retirement into perpetuity. If you have rental properties that are under control and you've paid them off, you have that income coming in each and every month. So that adds wealth and fixed income in your retirement. There are some other investments like commodities, and there's gold and silver, cash positions, annuities, stocks, bonds, mutual funds. So don't always think that your investments are nothing more than stocks, bonds, and mutual funds.
Yeah, Dean, good point there. The last thing I just wanted to do, just kind of summarize for our listeners, because we threw a lot at you out here. But when it comes to investing or paying off debt, again, ideally, we'd like to see you pay off all the debts first, not including the mortgage, so all your smaller debts. It's going to make it easier to invest. Now, if you do have access to a matching 401k plan or matching retirement plan, you can do both. You can contribute up to the match, pay off the debts, and then once you pay off the debts, you can increase your retirement account contributions. But ideally, we'd like to see you pay off all the debts first, not including the mortgage. Then once you do have that paid off, then go right into investing. Try and save 15% of your gross income into retirement accounts. Then once you have that 15% saved that you can save year after year, 15%, then go and try and throw any more income that you have to paying off your mortgage sooner. So again, then that's when lastly you want to go into the mortgage and pay off as much of that as you can based on the income that you have. Try and throw more at the mortgage and then save for the children's education at that point. So that's kind of the structure from top to bottom when it comes to investing or paying off debt.
Okay, that's all the time we have this week. See you later, and hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.